The Oracle of Omaha, according to the latest Forbes count, is currently tipping the wealth scales at $73 billion. This puts 87-year-old Warren Buffett at number 3 on the US rich list, behind Microsoft's Bill Gates and Amazon's Jeff Bezos. What's his secret? Let's find out in this video. How Warren Buffett got rich. This is Fraud Explained. To enjoy more videos, subscribe to my channel and click the notification bell, or else I'll be looking into you too. What's Warren's secret to his billions? Stay until the end to find out the key to his financial success. Warren Edwards Buffett showed his amazing aptitude for money and business at a very early age. Childhood acquaintances fondly recall his supernatural ability to calculate a string of numbers off the top of his head, a feat Warren still amazes business colleagues with today. The apple didn't fall far from the tree, since Warren followed in the footsteps of his father, Howard, a stockbroker turned congressman. Born on August 30, 1930, in his family with 2 sisters, his father and his mother Layla, Warren had big dreams of financial wealth and couldn't wait to get started on them. His father owned a small brokerage, and Warren would learn the trade by watching and listening to goings-on of the investors. As a teenager, he also took odd jobs, from washing cars to delivering newspapers, using his savings to purchase several pinball machines that he placed in local businesses. This is when he learned the wisdom of reinvesting his profits. In high school, he and a pal bought a pinball machine to put it in a barber shop. With the money they earned, they bought more machines until they had 8 in different shops. When the friends sold the venture, Buffett used his share to buy stocks and to start another small business. In 1947, Warren Buffett graduated from high school when he was 17 years old. He never saw the value of college, having already made $5,000 delivering newspapers, roughly the equivalent to $42,000 in the year 2000. His father wouldn't have it though, so Warren attended the Wharton Business School at the University of Pennsylvania. He didn't last long and left after just 2 years, complaining that he knew more than his professors. He moved back home to Omaha and transferred to the University of Nebraska-Lincoln. Endlessly persevering, he graduated in 3 years despite also working full-time. He didn't enjoy graduate studies much either, but was finally persuaded to try for Harvard Business School, which rejected him for being too young. To prove himself, Warren then applied to Columbia, where the great investors Ben Graham and Davin Dodd taught an experience that would forever change his life. He would forever thank Graham as a mentor whose class in securities analysis taught him the fundamentals of value investing. He even acknowledged that Graham's book, The Intelligent Investor, changed his life and set him on path of fundamental analysis of the investment markets. Along with security analysis, co-written by Graham and Dodd, the book provided him the proper intellectual framework and a roadmap for investing. Buffett sees himself as 85% Graham. Like his mentor, he focuses on company fundamentals and a long-term investing approach that looks for rich return on investment. For Buffett, this usually comes in the form of stocks that are valued accurately and offer robust returns for investors. However, Buffett takes a more qualitative and concentrated approach to investments. While Graham preferred undervalued, average companies and diversified his holdings among them, Buffett favors quality businesses that already have reasonable valuations and the ability for large growth. Seeing through the haze of public sentiment, Buffett never bases his decisions on what everyone else is saying or doing. When Warren began his career in 1956 with $100,000 pieced together from a handful of investors, he wasn't taken very seriously. He worked in Omaha, not on Wall Street, and was secretive with his partners about where their money was going. Many predicted that he'd fail, but 14 years later, he closed his partnership to the tune of $100 million. Warren Buffett made his first million by running a hedge fund. A hedge fund's value proposition is that it will make money for its customers. How exactly? You, the customer, give a hedge fund money and they invest it in assets that will grow, i.e. earn money, in time making your money grow with them. In turn, the hedge fund earns money from two sources, both from your money. 1. They charge you 2% per year of the money you put in. Example, you put in $1 million. They take $20,000 per year. 2. They take 20% of the profits. Example, if they grow your $1 million by 10%, meaning $100,000 profit, they take 20% of that, or $20,000. Combining the 2 and 20, they easily make $40,000 on $1 million investment. That returns 10% that year. After hedge funds, Buffett saw an even more lucrative option in owning small banks. How do banks outperform hedge funds? You, the customer, lend the bank money when you open a checking account or savings account. In exchange, they give you a small interest rate return on your savings account. How small? Let's just say you'll be lucky to find a 1% interest rate on savings accounts these days. They then use your money to lend to people who buy homes, cars, or other offerings. These loans usually charge 7% interest. The difference between 7% and 1% minus operating costs is what they make. Example, if you put $100,000 in a savings account, you might make a $1,000 profit in a year. They use your $100,000 to lend to people at a 7% interest rate, translating to $7,000 of profit a year. After you get your $1,000, they are left with $6,000. Imagine that multiplied by the number of accounts in one bank. This easily outperforms a hedge fund. Both hedge funds and banks, though, give the customer the option to take back their money. Buffett saw this, so he pivoted to a business that makes 5 times the money without investors getting their money back. At least, not without grave illness, injury, or death. You guessed it, he put all his money into running an insurance company that by nature tries to never give you your money back. Insurance companies make money from 2 sources. One is from premiums of people, just like you, who get a plan from them. 2 is from their investments they make with the money they got from you. Unlike hedge funds, that you give most of the money from the investments, insurance companies keep 100% of the profits. You don't get any of that action. What about the claims the insurance company pays out to people who do get sick or worse? Well, great insurance companies, Buffett's being one of them, use the power of statistics and probability to only take money from people who they think won't get sick. A good example of the crazy money-making potential of insurance was after 9/11, when Warren went on CNBC and said there is an almost certain chance that a nuclear weapon will be used on US soil in the next 50 years. To supposedly help with this, his insurance company then offered a new product, nuclear attack insurance. Listening to the Oracle of Omaha, big events like the Super Bowl would buy nuclear attack insurance for millions of dollars. Since a nuclear attack is highly unlikely, Buffett would collect millions for free. If there was a nuclear attack, then, well, we have bigger problems in insurance. You can see why Warren always says he skips to work. To make work and life even easier, he mostly delegates the management of all the businesses he owns and only gets involved in investments that are rare and large enough to warrant his patient attention. An example of this rare investment was a small penny stock that was trading for less than their liquidation value, otherwise known as cigar butt stocks. Meaning, if they sold everything they had, an investor would either make money or at least get the money back. Upon seeing this, he bought many shares and then called the CEO to offer some advice. He told the CEO to buy back shares at a higher price, so that the price could go higher, with only a limited number out in the market. With this, Warren worked out a price for his shares for an almost instant profit. Still seeing potential, he repeated the investment, but this time the CEO offered a lower price. Warren did not like this, so being the savvy investor, he bought up more than 50% of the shares and fired the CEO. What was the name of the company? It was called Berkshire Hathaway. Buffett always had a mind that rose above public opinion. It's how he developed his own method in choosing companies, something I'll share with you at the end of this video. Of course, this is not to say Buffett never had a rough time. He and his company rolled with a lot of Wall Street punches throughout the years. In 1975, Buffett and his business partner, Charlie Munger, were investigated by the Securities and Exchange Commission for fraud. The two maintained their innocence and said that their transaction only looked suspicious because of their complex system of business. More recently, Berkshire Hathaway completely pulled its stakes in the four major US airlines, as the coronavirus pandemic pushed the highly respected investment firm to $49 billion quarterly loss. This goes to show that even the Oracle of Omaha can make mistakes. What's more important is he's not afraid to cut his losses. He's not afraid to weather and even profit during times of crisis. During the Great Recession, Warren boldly invested and lent money to companies that were facing bankruptcy. These acts paid off 10 years later with enormous benefits. Some of them, including Wells Fargo & Company, which Berkshire Hathaway bought almost 120 million shares of during the Great Recession, now up more than 7 times from its 2009 low, and American Express, which is up about 5-fold since Warren's investment in 2008. Another great example from the middle of the financial crisis was with Goldman Sachs. Knowing their desperation, he personally called them up and offered a deal they couldn't refuse, when everyone was losing faith in them. A $5 billion investment in exchange for 50 million preferred shares at $100 a share. Note that in the event of bankruptcy and company liquidation, preferred shares get paid out before regular shares. In short, his money was safe. He also got a discount of $15 a share. On top of that, he got 43 million warrants to buy GS stock at $115 a share at any time he chooses. Finally, he got a 10% dividend, meaning $500 a year. 2 years later, he sells his shares back to Goldman Sachs for a $640 million profit. To follow it up, he capitalized on his warrants and bought 43 million shares at $115 a share, when everyone else was paying $190 for them. A literal second later, he sold those same shares for a profit of more than $3.2 billion. Altogether, this totaled a $4 billion profit on a $5 billion investment. This was made possible because he is the Warren Buffett, the Oracle of Omaha that Goldman Sachs desperately needed as a beacon of confidence. He continues to stay the course until today. Warren has partnered with 3G Capital to merge J.H. Heinz Company and Kraft Foods to create the Kraft Heinz Food Company. This move will make the new company the third largest food and beverage company in North America, and the fifth largest in the world, boasting annual revenues of $28 billion. In 2017, he bought up a significant stake in Pilot Travel Centers, the owners of the Pilot Flying J chain of truck stops. Over a 6-year period, he will become a majority owner of the said company. Never one to brag, it was a long time before Warren was noticed by Forbes' list of richest Americans. When they finally did in 1985, he already had billions to his name. His early believers in Berkshire Hathaway bought shares for as low as $275 apiece. These shares reached $200,000 apiece in 2014 and just under $300,000 earlier this year. With all this money, you might think that he's getting murdered by taxes. Well, think again. Warren Buffett is rich because he owns $80 billion worth of Berkshire Hathaway stock. He doesn't have to pay taxes until he sells those stocks. On paper, his salary is something like $1 a year. Yes, you and everyone else pay more income taxes than the Warren Buffett. He extends this tax haven to his children, whom he gave a $3 billion charitable foundation each, giving them a salary of tens of millions a year and saving them from having to pay an inheritance tax. He also saved on an enormous estate tax, usually paid by every other rich family, by pledging to donate the remainder of his money to the Bill and Melinda Gates Foundation. This is not to say that he isn't charitable. In fact, he uses the argument that his secretary pays more taxes than he does to justify the rich paying more taxes. He and co-billionaire Bill Gates have been proposing this since last year. Aside from his tax havens, what's his secret in making his billions? He resists the allure of the public's next big thing, and instead abides by his formula of consistent earning power, a good return on equity, capable management, and sensible pricing. Companies that have been consistent with their positive and acceptable ROE for many years are on top of the list compared to companies that have only had a short period of solid returns. The longer the number of years of good ROE, the better. A good period to review for an investor would be at least 5 to 10 years of a company's ROE. On the flip side, having a large ratio of debt to equity should be cause for alarm, because if more of a company's earnings are going to go towards servicing debt, most likely growth will only come from accruing more debt. How are profit margins? Buffett enjoys companies with good profit margins, better if they're also growing. To do away with short-term noise and trends, he sticks by his review of several years of a company. If a company's management grows their profit margins year over year, it's a good sign that they're also excellent in controlling operating costs. How unique are the company's products? Buffett looks for the one-of-a-kind products, those that aren't easily replaced, so there'll be less risk future-proofing forward. How much of a discount are shares trading at? Here lies the greatest challenge of value investing, finding companies with solid fundamentals that are trading below their intrinsic value. If you find this, the greater the chance for profitability. The bottom line for value investing is undervalued companies compared to their intrinsic value. When one sees a discount of a company compared with its intrinsic value, it's a golden opportunity to buy. The formula for intrinsic value varies per investor and is a mix of various external factors, like economy and technology, and internal ones, like corporate governance and future earnings potential. You might be surprised, but despite his wealth, Buffett does not measure success by it. As mentioned before, he even previously pledged to give away most of his grand fortune to charities, mostly to the Bill and Melinda Gates Foundation. He also absolutely hates monuments to himself. No Warren Buffett buildings or halls. Instead, he measures success by how many of the people you want to have love you actually do love you. For him, that's the ultimate test of how you've lived your life. Warren Buffett is a true testament to working hard and playing hard. Do you think you have what it takes to follow in his multi-billion-dollar footsteps? Tell us how you plan to do so in the comments down below. I'll be responding to all comments in the first hour. If you were inspired by the story of Warren Buffett, by all means, try my related video, The Story of Bill Gates. Here I tell his story and the secret to his multi-billion-dollar company. Stay tuned, stay educated.